Foreign exchange reserves this July had dropped by $342 billion from last year's historic high of $3.99 trillion, a reversal of the long-term growth in China's foreign reserves. It turns out, however, that's hardly a problem of a cross-border capital flight. In fact, China's trade surplus was $305 billion in the first 7 months, more than twice the previous year's figure.
Market expectation of foreign exchange rates has changed. People have changed their attitude to foreign assets. They are now coming out of the central bank and into the hands of individuals.
Lin says the prospects of a stronger US dollar is another factor in the increasing willingness to invest in dollar-dominated assets or to hold dollars as a reserve currency. Another factor in the reserves decline is that in the first half of the year, the government took $93 billion out of the foreign exchange reserves and put it into the China's Development Bank and the Export-Import Bank of China, where it can support China's One Belt, One Road initiative. The downward trend of the foreign exchange reserves will continue, according to Liu Xuezhi, senior analyst of the Bank of Communications. He says China's continuing economic reforms in the coming years will further bolster overseas investments.
It is related to the developments of the real economy. Overseas investments like One Belt, One Road initiative, Chinese enterprises expansion, all can cause capital outflows and bring the forex reserves down. So capital outflow is connected to economic transformation and does not necessarily have much of a negative impact.
Despite the decline, China still has the largest foreign exchange reserves in the world. Premier Li Keqiang once said that a large sum of foreign exchange reserve, in fact, could be a burden to the country, because it would pump liquidity into the market and lead to inflation.
The best way to improve the profitability of reserve investments is to let Chinese enterprises hold foreign reserve and invest them. If overseas investment channels are opened up, Chinese enterprises will be more likely to invest in profitable, risky, or low convertibility assets. The best way to improve profitability is to ensure that exchange reserves are in private hands.
Lin calls for the lifting of foreign exchange restrictions on exchange rates, convertibility, and cross-border investment, saying these are the prerequisites for Chinese enterprises to extend overseas investments. Cai Jue, ICS for CCTV, Shanghai.